Corporate equity transaction. Using examples, we will walk through various equity transactions for a corporation. First, let's look at the sales of stock and the repurchase of Treasury shares. Selling common stock. Whenever you sell common stock, it's based upon the market share as of the date of the sale. So in this instance, we're looking at selling 2,000 shares. The market value on the date of the transaction is $15, and our common stock is valued at $10 par. So this means that the common stock at $10 par value, the common stock, the value in this general ledger account will always be the number of shares issued times the par value. So we'll always be limited to that. So this is 2,000 shares times $10 per par, meaning that we have $20,000 in common stock representing these 2,000 shares. Now, what will be in paid-in capital in excess of par common stock will be the 2,000 shares and any dollar value over par. So we see that it was a $15 market value as of the date of the sale. We're limited to $10 in par to $10 per share for par. So that would mean that paid-in capital in excess of par would be valued at $5. 2,000 shares at $5 would be $10,000, or alternatively, you can look at it as though it's 2,000 shares at the market value as of the date of the sale, $30,000, then the 2,000 at $10 par, $20,000, and then the $10,000 will be the difference. But in order to prove that, I've shown you the calculation. Now let's look and see what would happen if we sell preferred stock. Well, it's the same type of thing. You're going to receive cash based upon the number of shares and the market value as of the date of that sale. Again, preferred stock can have a par value, and in this instance, it was a $5 par value, so it'll be 3,000 shares times $5 par value, and so what will be booked into this general ledger account will be limited to its par value times the number of shares. Paid-in capital in excess of par, we've changed the description here to preferred stock in order to differentiate it from common stock, but it's 3,000 shares times $15 over par. Our market value was 20, our par was 5, so it's $15 over par, $45,000. Now let's look at Treasury stock. Treasury stock is a repurchase of shares of stock that are currently in the hands of stockholders that have been repurchased by the company for which they will be paying cash. So in this instance, they repurchased 100 shares, and the market value as of the date of the repurchase was $12. So our journal entry is $1,200 for Treasury shares, which is a contra equity account. So this would be shown on the stockholders' equity section of the balance sheet as a reduction of stockholders' equity. Notice it's being debited. And cash, the cash we're paying out, $1,200. Now, if we were to reissue this Treasury stock, the repurchase price resets the par value associated with this stock. So it would no longer be the original $10 par value. Now it would be a $12 par value based upon the market value as of the date the Treasury stock was repurchased. So in this instance, we're going to receive cash, we're going to sell 50 shares, and the market value as of the date of the sale of these shares to whoever would be is $15. Our Treasury stock common is going to be limited to the new reset par value based upon the original transaction when they repurchased it, and the market value as of that date was $12. And so it's going to be 50 shares times $12. And then our paid-in capital Treasury stock will be 50 shares, and it'll be $3 over the repurchase price in order to value the amount that would be booked in the general ledger account paid-in capital Treasury stock. Next, let's look at cash dividends. Dividends are not available unless declared by the board of directors and there are sufficient retained earnings. So just because your company would pay dividends, it is not automatic until it's declared by the board of directors. Now, there's 3 dates that are of importance when you talk about cash dividends. The date of the declaration. On the date of the declaration, because you've entered into a transaction declared by the board of directors and it activates the cash dividend process, the amount that will be taken out as a dividend will come out of retained earnings. So it's the amount out of retained earnings that you want to distribute back to your, in this instance, it was common stockholders. And so since it creates a liability, it's going to be credited to common dividend payable to demonstrate to those that are reading the financial statements that $50,000 will be taken out of retained earnings, and it represents a common dividend payable, a liability. Now, the date that the board of directors declare the dividend, they have to wait until they know for certain who owns that stock. So they have to declare a certain date of record. And everyone who owns the stock as of that date, which is typically 2 weeks after the date of declaration in order for them to catch up on all of their bookkeeping, everyone as of that date who holds the stock, the date of record, will be issued the common stock cash dividend. So this doesn't require a journal entry. It's just a housekeeping type of thing in order for them to be able to determine who they're going to pay out the dividends to. Now, the date of payment is going to engender the cash payment. So, of course, we need a journal entry. So we're going to debit common dividend payable. So we're going to establish the liability, and then now we're going to debit the liability and essentially say that the liability has been paid, credit cash for the amount of the cash payment out associated with the dividend. And again, this is a payable because it creates a liability on behalf of the corporation, and we're going to contrast it now with a with a stock dividend. So let's look at this. A stock dividend. It is capitalizing retained earnings. It transfers an amount from retained earnings to common stock. So it's just transferring amounts in the stockholders equity section of the balance sheet. So it's coming out of retained earnings and going into common stock. The board of directors declare a small stock dividend. Well, what is a small stock dividend? It's less than 25% of issued common shares. So how do we calculate this? Well, first of all, you need to look at the number of common shares issued and outstanding. And in this example, it's 10,000 shares. So the board of directors declare a 10% stock dividend. So this means that every shareholder is going to get 10% more stock. And so this will be the stock dividend. 10% means that the number of dividend shares that will be issued will be 1,000 shares. The market value is going to set the amount that will be taken out of retained earnings, so the market value will be set as of the date of declaration. So the date that they declare the stock dividend is the market value, and that was $15 in our example. And so the number of shares was 1,000. So this means the value of the distribution will be $15,000. So just like it is with a cash dividend, we're going to be taking this amount out of retained earnings. So that'll be $15,000, and this is 1,000 shares times the 15 market price on the date of declaration. Now we are going to credit common stock dividend distributable. Now this is distributable, not payable. There's a difference. This represents to readers of the financial statements that this is going to be a stock dividend, not a cash dividend. So it's the 1,000 shares times the $10 par value associated with the common stock. It is never a payable since it is not a liability but a capitalization of retained earnings. The paid-in capital in excess of par common stock will be any amount over par. So it would be the 1,000 shares, $5 over par. Par value was 10, market value was 15, so it'll be $5 over par. Now we have this crazy little journal entry that they're going to have on the date of payment. So this will be debiting common stock dividend distributable to show the readers of the financial statements that this distributable common stock has been, that obligation has been met. And then they're going to credit common stock $10 par value, $10,000. Notice the journal entry does not include paid-in capital in the general ledger account. So notice that the paid-in capital portion of this transaction was booked to the general ledger as of the declaration date, but as of the payment date or the distribution date, that it is not, there's no journal entry that affects paid-in capital in excess of par. So it's a crazy little set of transactions there. Now, let's look at preferred shares. Now, one of the reasons why a company will issue preferred shares is so that they don't give up a certain ownership percentages and can retain ownership percentages. And so to entice people to invest in the company, they're going to give them a preference in dividends to those that have preferred shares. They also have a preference in liquidation. The creditors would be paid. Next, the preferred stockholders would be paid. Lastly, the common shareholders would be paid. And the reason for that, the reason why the common shareholders are paid last is because they have the voting shares, and they're the ones, if the company's in liquidation, that have run the company into the ground sufficiently that it has to declare that it is no longer a viable company and liquidates. So the creditors will be satisfied first. After that, the preferred shareholders, and finally, the common stockholders. All right, so non-cumulative preferred shares. The company has outstanding preferred stock of 70,000 shares of non-cumulative 8% $5 par preferred stock. It also has common stock outstanding or issued of 100,000 shares with a par value of $2 per share. Now, how do we calculate the amount of dividend that the preferred shareholders should receive? Well, first thing we want to do is look at the number of outstanding preferred shares there are. In our example, it's 70,000. We're going to multiply that by the par value of the preferred shares, which is $5, and that's going to give us the total par value by which we can determine how much should the dividend be. Since it's 8% of par, the total par value, 350,000 times 8%, will be 28,000. So in each year, the shareholders should receive 28,000. Now, this is non-cumulative, meaning that each individual year is looked at separately insofar as what amount of dividend goes to the preferred shareholders and what amount of dividend goes to the common stockholders. So we have 4 years and the different dividends that were declared. So in the first year, $15,000 were declared. Well, that's under the $28,000 threshold, so the entire amount will go to the preferred shareholders. In the second year, a $14,000 dividend was declared. So again, that's under the $28,000 threshold, so the entire $14,000 would go towards the preferred shareholders. In the third year, a $55,000 dividend was declared. So $28,000 would go to the preferred shareholders, so their portion is limited to $28,000. So the common stockholders would get $27,000, and that's over the $28,000 threshold. So the minute you look at it and see that it's over the threshold of the percentage due to preferred shareholders, you know a certain portion is going to go to the common stockholders and a certain portion will go to the preferred shareholders. And right now, the preferred shareholders are probably pretty happy about the way things are being divvied up. But in this year, when they declare $125,000 dividend, and they're only receiving $28,000, because that's the $125,000 is over the $28,000 threshold. That means the remainder goes to the common stockholders. Now the preferred stockholders may think they want to become a common stockholder instead because they're getting the lion's share of the dividends. Now let's look at cumulative preferred shares. Cumulative preferred shares. So we have the same scenario, and we also have the same calculation. So outstanding preferred shares, 70,000, par value 5, total par associated with preferred shares is 350,000. There's an 8% dividend that goes to those shareholders. So the percentage due, or the dividend due to preferred shareholders is $28,000. So in this year, they declare a $15,000 dividend, but now because it's cumulative, we have to look at the amount in arrears each year, the amount that didn't get paid to preferred shareholders. So in this year, because it's under the $28,000 threshold, the entire $15,000 will go to preferred stockholders. And so we have to calculate now. They almost have to look at this like layers of inventory, the amount in arrears. So $28,000 should have gone to the preferred shareholders. They received $15,000, so that means that the company was in arrears $13,000. So now let's look at it in the following year when they declare a dividend of $14,000. Well, the dividend, they have to catch up with the arrears. So the arrears owed to the prior year out of this $14,000, since it's under the $28,000 threshold, we know the entire amount will go to preferred shareholders. So the first $13,000 of this $14,000 dividend is associated with the prior year's in arrears dividends that should have been paid. And out of the 14 related to the current year is only going to be this $1,000. So now we said we'd look at it like layers of inventory almost. Amount in arrears of prior year. So the amount in arrears for the current year, they should have gotten $28,000. They were only paid $1,000 out of that. So that means that in the next year they're going to be $27,000 in arrears. So let's look at that. In the next year, they declare a $55,000 dividend. Well, in relationship to what they are in arrears, it was $27,000. Now, this $55,000 is over the $28,000 threshold, so we have to look at, once we paid out the $27,000, how much is left to be divvied out between the preferred shareholders and the common stockholders. Well, when we subtract $27,000 from $55,000, we see that the amount is left over is $28,000, so that in its entirety would go to the preferred shareholders for the current year. So amount in arrears prior year is $27,000. Amount in arrears current year, well, they were supposed to have paid them $28,000. They did pay them $28,000, so there is no amount in arrears for any upcoming dividend declarations in upcoming years. And so in the subsequent year, they declare a $125,000 dividend. $28,000 would go to the preferred shareholders, and $97,000 would go to the common stockholders. Again, there's a lot of decisions that have to be made once they're over the $28,000 threshold as to what amounts belong to the prior years for preferred dividend stockholders, what's in arrears, what's currently payable to them if there's any current amount in arrearage, and what, if any, would go to the common stockholders.